To episode 2 of infra-analysis, infra-modeling. So last episode, we built out the debt sizing. We're going to build out some debt metrics, which is PLCR. So that's the project life coverage ratio, basically taking your forecasted cash flows, present valuing them back, and then comparing those to your debt balance. Then we're going to run some basic returns. And to run returns, we need to set up an equity distribution account, beginning period, and the ending. Simple as that. PLCR is present value the cash. Build it based on a premium of the all-in rate. And we're going to format this in a way where it's just a reference. And then we're going to go Control C, Alt ESL, and pull that in as a link as our discount rate. And oftentimes you'll see a premium to your all-in rate. That's what rating agencies like to do. More draconian view on interest rates and see how resilient the structure is. So all we're going to do here is take a simple XNPV using this rate, and we're going to go look at the forward-looking values. So our forward-looking CFAD, and we're going to lock in this period, the same thing, but with the dates. So take these, copy, paste, grab your period you want, and then you have your present value of cash flows. Okay, flows over the debt balance at the time. And we're going to, because we're using a forward-looking metric, we're going to use the end of period debt balance. So we're just going to go put a simple if error on here, and then we're going to take the ending debt balance is to go in and ensure that this amount is always over 1, especially at your refinancing period. But basically what this is going to tell us is what is going to be refinancing value of these cash flows at a higher rate. And obviously you're not using a DSCR, and that's why you're looking for the 110, but you're taking your CFADs, discounted back, and comparing that to your debt balance. So you want some sort of coverage. You're already using this buffer and rate, so 110 is generally going to be your preferred minimum value for that. Next thing we're going to do here quickly is we're going to go in and build an equity distribution account. And what an equity distribution account is goes and governs whether we can distribute cash flows in project finance. So there's a DSCR that we need to size on, but there's also a distribution condition you need to meet in order to distribute cash on hand. So contribution, distribution, close. Okay, with cash available to distribute your CFADs less your debt service, because that's what's next. That's how the waterfall goes. You have to pay CFADs is your revenue less your OPEX, all that kind of stuff, maintenance, CapEx. Then you get down to debt service. That's next in the waterfall. And finally, it's your cash flow available to distribute. A test that is the DSCR above our distribution threshold. Greater than our DSCR, is this greater than our distribution test? Okay, and we're going to put an AND function. This is greater than that, and we're in the operating period or term conversion period. Okay, that's going to be false, and our contribution is going to be our cash flow available to distribute. It goes into this account no matter what, so we're not testing it here. But to distribute it, we're going to go negative sum of this times this, okay? And that's going to create an account for us that goes in and basically allows us to distribute in each of these periods. Now, if I don't meet the test, we're going to start accumulating. So we could have quite a bit of cash on hand, but we're not distributing it, and you'll see how that impacts our returns. What our project cost is going to be, or purchase price. So project cost / purchase price to be generic. A multiple of our annualized CFADs. So how are we going to do that? We're going to go in and say annualized CFADs, and everything we do, we want to be as formulaic as possible. So we're going to start with this, and we're going to say 2027 is going to be our annualized CFAD. Then the next thing we're going to do is we're going to take this, and we're going to go equals sum of our, well, we're going to have to build this out. We're going to build month, and this is going to be, what we're going to do is we're going to use the round down function And we're going to do this, divide by 3 and 0 digits, and that's going to get us a quarter, and Q1, Q2, Q3, assuming the calendar year. Finding our annualized CFADs equals sum if. We're going to take the range, then we're going to take our criteria, which is this guy, and then our sum range is just going to be our CFAD. Next thing we're going to do is we're going to assume a purchase price. So let's say 10 times CFADs, okay? We're going to go here times here for $1 billion. Assuming we're in operating period, it's going to be a purchase. We're going to purchase at financial close times this guy unlevered IRR. So we're going to CFABs here again for project cash flow and net cash flow. Okay, pull this down. All we're going to do is link our CFABs. So these are positive cash flows we're earning. Okay, and we have our net cash flows, and we're going to do a simple formula that just ensures our IRR is always going to work. So we're just going to go equals if this is less than 1, then negative 0.001. We can otherwise sum. Okay. And what that's going to do is just allow us to go in and have a working IRR function in the period prior to. So if we change this time series, the IRR will still work. Next, we're going to do and calculate the unlevered IRR. Okay, and that's going to be a percentage. Take this, and we have positive cash flows here. So we should have a positive IRR as long as we don't have too much of a back-weighted return. So we're going to take this, and we're going to go equals X IRR values dates. We'll get to a very low IRR. And the reason that IRR is so low is because our purchase price is too high. So here's our first analysis of how much do we want to pay for this? A lot of that in infrastructure finance is going to be based on your cost of capital. So, and your primary cost of capital is going to be your debt quantum. So if you have 607 million of debt, we're looking at 57% levered. So you would want this around. Typical purchases are going to be between 80 and 90% leverage. So we'll go with 7.5. But we're not going to lever this more than 80%. It's hard to find in the market. Some sponsors are able to do it, but it's quite aggressive. And eventually will have an impact on your yield. So then we're going to go into levered returns. We're going to build up our purchase price, our debt issuance, our debt service, and our distributions. And we do that because these are all going to basically be on a net equity. Our debt issuance is going to make this on an equity basis as we get the benefit. The last thing is going to be our distributions, which are going to be here. And we're going to make that a positive value. Really important to grab this because like we did previously, you're not going to get returns if you're not hitting your distribution test. So pretty vital to go in and pick that up. So we get down to our distributions here, our levered IRR. And let's just go and make sure we lock in our time series before I pull this down. And then it's just as simple as replacing this levered IRR is 10.37%. And that makes sense because our cost of capital at 6.25%, our debt cost of capital is less than our project return. And you'll see, we'll just do some quick analysis here on the IRR. If our purchase price becomes too much, where our project unlevered IRR is less than our cost of debt, so our project IRR is less than our cost of debt, we're all of a sudden going to have no returns because we're paying 300, we're getting net negative 64 million out of this because you're basically just servicing debt. You're not ever making a return on your project unless you refied it or recontracted it and put new debt on here, which we will get to eventually. But essentially, here's our levered IRR. All of a sudden, there's now juice in this for the equity investor because our cost of capital we're primarily levered capital stack perspective, so we're actually getting quite a bit of return. And then once you see, oh, okay, we only paid 7 times CFADs, all of a sudden we have quite a frothy return, and almost 100% of that is due to debt. So I hit Control 9 just to clean that up. I think that's all I had on plan for the second video. Next video, we're probably going to go into, let's just set this up. So our third video is going to be, let's talk about maybe MOIC, holdco debt, interest only periods, and we'll see what those have an impact on each of our tranches, and we'll start to build this out slowly over time. And feel free to provide comments for any analysis that you'd like to see that would be helpful. Thanks for everyone watching.